Imagine waking up tomorrow morning to discover that one of the world's largest banking systems suddenly tells millions of investors they can no longer trade gold the way they always have. No warning, no gradual transition, just a deadline, and after that, access disappears. At first glance, it sounds like another government stepping in to protect investors from volatile markets. But what if that's only the surface? What if this decision is actually part of a much larger financial transformation that has been quietly unfolding for years? And what if the biggest story isn't that China is restricting gold trading, but that it's changing the rules of how the global financial system works? Because once you connect all the pieces, this stops looking like a simple banking policy. It starts looking like the opening move in a battle over who controls the future of money. Welcome back to Money Forever. Today we're going beyond the headlines to examine what China's latest decision could really mean, not just for gold investors, but for the US dollar, central banks, inflation, and the global economy itself. And trust me, by the end of this video, you'll understand why many professional investors are watching this story far more closely than the mainstream media. Let's begin. On June 24th, one of China's largest financial institutions, the Industrial and Commercial Bank of China, better known as ICBC, announced that it would discontinue several of its paper gold trading services for retail investors. Existing positions would eventually be closed, and new trading through these products would no longer be available after the implementation period. This wasn't an isolated decision. Within weeks, several other major Chinese banks either announced similar restrictions or had already begun reducing access to comparable products. Among them were Postal Savings Bank of China, Ping An Bank, and China Guangfa Bank. Whenever multiple systemically important banks move in the same direction within a short period of time, experienced investors pay attention, because banks rarely make identical strategic decisions by coincidence. Naturally, the first question everyone asked was simple: why now? According to the official explanation, the answer seems straightforward. Gold prices have experienced extraordinary volatility over the last year. After reaching record highs earlier this year, gold experienced sharp corrections as investors reacted to changing interest rate expectations, geopolitical developments, and shifting global liquidity conditions. Retail investors using leveraged products were taking increasingly large risks. From the bank's perspective, restricting high-risk speculative trading helps reduce potential losses for inexperienced investors. On paper, that explanation makes sense. Higher volatility, higher leverage, greater risk, more restrictions. Many countries have implemented similar policies in different asset classes over the years. But here's where things become interesting. China isn't banning gold ownership. It isn't preventing citizens from buying physical gold bars. It isn't closing jewelry stores. It isn't stopping long-term investment in precious metals. Instead, it is specifically targeting leveraged paper trading products. That distinction matters, because paper gold and physical gold are not exactly the same thing. Most people assume buying paper gold means they own actual gold. In reality, that's often not how these markets work. Think about it like this. Imagine there's a rare collectible baseball card worth $1,000. The physical card sits safely inside a vault. Instead of selling the card itself, someone creates certificates representing ownership of that card. People begin buying and selling those certificates every day. Most never ask for physical delivery. They simply trade the certificates. Now imagine demand increases. Rather than moving the actual card, the market creates more certificates representing future claims. Soon, dozens of certificates exist, while only one real card remains inside the vault. Trading activity explodes. Prices move constantly. Yet almost nobody ever touches the real asset. That simplified example helps explain how many paper commodity markets operate. They're incredibly efficient for trading. They're highly liquid. But they don't necessarily require physical delivery. For decades, major global exchanges have relied heavily on futures contracts and other financial instruments that allow enormous volumes of gold to change hands without actual bullion moving anywhere. There's nothing inherently wrong with that. In fact, these markets serve important purposes. Mining companies hedge production. Manufacturers lock in future prices. Institutional investors manage risk. Liquidity improves price discovery. But critics have argued for years that paper trading volumes have grown so large compared to physical metal that prices may sometimes reflect financial speculation more than immediate physical supply and demand. Whether one agrees with that argument or not, it's a debate that has existed for decades. Now consider China's latest decision from that perspective. Instead of restricting physical ownership, Chinese banks appear to be reducing access to leveraged paper products. Why would they do that? Perhaps because excessive speculation creates financial instability. That's certainly possible. Or perhaps regulators believe physical ownership is healthier than leveraged financial betting. That's another reasonable explanation. But some analysts believe something even larger may be happening beneath the surface. Before we explore that possibility, let's step back and look at what central banks themselves have been doing. Because while headlines focus on retail investors, governments around the world have quietly been behaving very differently. Over the past several years, central banks have purchased gold at one of the fastest rates seen in modern history. According to publicly available data from international organizations, official sector demand has remained exceptionally strong as monetary authorities diversify portions of their reserve assets. Why? Central banks don't buy assets based on social media hype. They don't chase momentum. They think in decades, not days. Their job is preserving purchasing power, maintaining confidence, and preparing for uncertainty. When dozens of central banks simultaneously increase gold holdings over multiple years, investors naturally ask an important question. What are they preparing for? No single answer exists. Some governments may simply want greater diversification away from foreign currencies. Others may be responding to geopolitical tensions. Some may be strengthening confidence in their own financial systems. Each country has different priorities, but regardless of motivation, the trend itself is difficult to ignore. At the same time, another long-term trend has been developing. China has gradually reduced portions of its U.S. Treasury holdings over many years while continuing to strengthen various aspects of its domestic financial infrastructure. Again, this doesn't necessarily indicate confrontation. Large reserve managers routinely rebalance portfolios. But viewed alongside increasing gold purchases, growing domestic exchanges, and new settlement initiatives, a broader strategic picture begins to emerge. Here's another question worth asking. If China truly wanted to discourage gold ownership, why has it spent years expanding its own gold market? The Shanghai Gold Exchange has become one of the world's most significant physical gold trading centers. Chinese consumers remain among the largest buyers of physical gold globally. Jewelry demand remains substantial. Investment bars continue attracting buyers. None of that suggests a country trying to eliminate gold. Instead, it suggests a country carefully deciding how gold should be traded. That's a very different objective. And this is where many investors begin connecting additional dots. Because reducing speculative paper trading, while encouraging stronger physical market infrastructure, could gradually shift attention toward actual bullion instead of purely financial contracts. Whether that becomes the long-term outcome remains uncertain, but it's a possibility worth watching. Now let's think even bigger. For generations, international commodity pricing has largely revolved around financial centers like New York and London. These markets became dominant because they offered liquidity, transparency, and deep pools of capital. That system helped shape global trade for decades. But economic power evolves. Trade patterns change. Financial centers compete. China has spent years building institutions designed to increase its influence within global commodity markets. Energy exchanges, currency settlement systems, cross-border payment networks, gold infrastructure. None of these developments happened overnight. They've been developing gradually, almost quietly. Each individual project may seem relatively small. Together, however, they point toward a broader strategic objective: greater financial independence, greater pricing influence, greater resilience against external shocks, and perhaps eventually a larger international role for China's own financial system. Now think back to today's headline. If retail paper speculation decreases while physical trading infrastructure expands, could that eventually place greater emphasis on real metal movement? Some analysts believe so, others disagree. That's perfectly normal. Markets thrive on differing opinions. But regardless of where someone stands, one fact remains. Major structural changes inside the world's second largest economy deserve attention. Because financial history teaches us something important. Big monetary shifts rarely happen overnight. They happen gradually. One policy here, one regulation there, a new payment system, a new settlement mechanism, a reserve diversification strategy, a banking reform. Each step appears relatively insignificant by itself. Only years later do people look back and realize they were watching the construction of an entirely new financial architecture. Could today's announcement become one of those moments? Nobody knows. But history suggests investors should never dismiss structural changes simply because they appear technical or boring. Sometimes the biggest financial revolutions begin with policy announcements almost nobody understands. Here's another point that often gets overlooked. Financial markets ultimately depend on confidence. Confidence in currencies, confidence in banks, confidence in governments, confidence in settlement systems. Once confidence changes, capital begins moving, slowly at first, then suddenly. That's why professional investors spend so much time studying behavior rather than headlines. What are central banks buying? What are sovereign wealth funds doing? How are regulators changing market rules? Where is physical capital flowing? These questions often provide more insight than daily price movements. And right now, many of those signals point toward increasing global interest in tangible reserve assets. Not because paper assets are disappearing, not because the dollar is collapsing tomorrow, but because uncertainty itself encourages diversification. That's exactly what prudent institutions tend to do. They prepare before everyone else notices the need to prepare. And perhaps that's the most important lesson from today's story. Whether China's decision ultimately proves revolutionary or simply precautionary, it reminds us that the global monetary system continues evolving. The assumptions that defined finance 20 years ago aren't necessarily permanent. New institutions emerge, new payment systems develop, new reserve strategies appear, new competitors challenge existing frameworks. And somewhere within all these gradual changes, opportunities begin forming for investors willing to pay attention before the crowd does. But here's where this story becomes even more fascinating. Because China's restrictions on paper gold may only represent one half of a much larger strategy. The second half involves something that could eventually influence how gold itself is priced internationally, and if that process continues accelerating, it could reshape the balance of financial power in ways very few people are discussing today. And that's exactly where we're going next. China's decision becomes even more intriguing when you stop looking at what it's restricting and start looking at what it's building. History has shown that powerful nations rarely dismantle one financial system unless they already have another one waiting in the background. Markets don't simply disappear, they evolve. And when governments make coordinated moves involving banks, settlement systems, and precious metals at nearly the same time, experienced investors begin asking a very different question. Not, what are they shutting down? But what are they preparing to replace it with? Because over the past decade, China has quietly invested billions of dollars into creating financial infrastructure that receives very little attention outside professional investment circles. Most people hear about stock markets, interest rates, or inflation. But beneath those headlines lies another layer of finance, the plumbing of the global monetary system. These are the exchanges where commodities are priced, the payment systems that move capital across borders, the vaults that store physical bullion, and the settlement networks that determine how international transactions actually take place. These systems aren't glamorous, but they determine who ultimately has influence over global finance. For decades, London and New York have occupied the center of this financial universe. Gold has traditionally been priced through markets that developed over generations, supported by enormous liquidity and decades of institutional trust. Whether investors agreed with the pricing or not, these financial centers became the benchmark the rest of the world followed. Nearly every central bank, mining company, manufacturer, and institutional investor looked toward those markets for price discovery. But China's long-term strategy appears to be moving in a different direction. Instead of relying entirely on foreign financial infrastructure, China has spent years expanding the role of the Shanghai Gold Exchange while strengthening Hong Kong's position as an international financial gateway. Individually, these developments may appear technical. Together, they suggest an effort to increase China's role in determining how precious metals are traded and settled internationally. Think about this for a moment. If two countries sell the same product, but one controls the marketplace where everyone comes to buy and sell, who really has the advantage? The answer isn't always the producer. Often it's the marketplace itself. That's why financial exchanges are so valuable. They don't simply facilitate trading. They shape pricing. They influence liquidity. They attract global capital. And over time, they become trusted institutions that other countries depend upon. Now imagine China gradually expanding that influence through physical precious metals instead of purely financial products. That possibility alone explains why professional investors continue paying attention, because physical delivery changes everything. When real bullion must actually move between buyers and sellers, supply becomes much harder to ignore. Speculation still exists, of course. Prices will always fluctuate. But physical settlement introduces an additional layer of discipline that paper contracts don't necessarily require. This distinction has fueled debate for years. Supporters of traditional futures markets argue that paper contracts create liquidity, improve efficiency, and help stabilize pricing. Critics argue that financial leverage can sometimes dominate physical supply, creating price movements disconnected from actual metal availability. Both perspectives contain valid points. Neither side has complete certainty. But China's latest actions suggest policymakers may be placing greater emphasis on physical market dynamics than leveraged retail speculation. That alone makes this story important. Now let's zoom out even further. Over the last several years, the global economy has experienced events few people expected. Supply chains broke down. Inflation returned after decades of relative stability. Interest rates climbed dramatically. Geopolitical tensions intensified. Trade relationships became more complicated. Sanctions increased. Reserve management strategies evolved. Each of these developments encouraged governments to reconsider financial resilience. Suddenly, questions that once seemed theoretical became very real. What happens if international payment systems become restricted? What happens if reserve assets become politically sensitive? What happens if countries need alternative settlement mechanisms? Those questions have driven significant investment into domestic financial infrastructure across multiple regions, not only China. And precious metals naturally become part of that conversation because they remain one of the few internationally recognized reserve assets without direct counterparty risk. Unlike sovereign debt, physical gold doesn't depend on another government's promise to repay. Unlike fiat currencies, it cannot be created electronically through monetary policy. That doesn't mean gold replaces modern finance. It simply means many institutions still consider it valuable as a reserve asset during uncertain periods. Now here's another fascinating development. While retail investors often focus on daily price movements, central banks think differently. They don't ask whether gold will rise 5% next month. They ask whether reserve portfolios remain balanced over decades. That's an entirely different mindset. And when dozens of central banks independently reach similar conclusions about reserve diversification, markets notice. Not because central banks are always correct, but because they possess access to enormous research capabilities and long-term strategic planning. Meanwhile, another trend has quietly accelerated. Several countries have increasingly explored settling portions of international trade using local currencies rather than relying exclusively on the US dollar. Again, this doesn't mean the dollar suddenly loses its global role. Far from it. The dollar remains deeply embedded within international finance. Its liquidity, transparency, and institutional framework remain unmatched in many respects. But diversification is not the same thing as replacement. Countries can reduce dependence without eliminating existing systems. That's an important distinction many headlines fail to explain. Financial evolution usually happens through gradual diversification, not overnight revolutions. And that's exactly why China's current actions deserve careful attention rather than emotional reactions. Because even if today's policy appears relatively small, it may fit within a much broader long-term strategy. Let's consider another angle. Imagine you're building a completely new airport. Would you announce the grand opening before constructing the runways? Of course not. First, you build infrastructure, then terminals, then logistics, then transportation. Only after everything functions together do passengers begin arriving. Financial systems operate much the same way. Before attracting international capital, countries first develop exchanges, settlement systems, clearing networks, vault capacity, regulatory frameworks, payment infrastructure. Only then can larger structural changes occur. Many analysts believe China has spent years completing precisely these foundational steps. Whether those efforts ultimately succeed remains uncertain. Markets, not governments alone, will determine adoption. Trust cannot simply be declared. It must be earned. That's why transparency, reliability, and consistent execution remain critical. Still, the direction of travel appears increasingly clear. China wants greater influence over global financial architecture. Gold happens to be one important component within that strategy. Now here's where many investors become particularly interested. Whenever significant monetary transitions occur throughout history, they rarely benefit those who wait until every headline confirms the change. Instead, opportunities often emerge while uncertainty remains high. Think back to previous financial transformations: the rise of electronic trading, the emergence of exchange-traded funds, the globalization of bond markets, digital payments. Initially, many dismissed these developments as niche innovations. Years later, they became mainstream. Could precious metals experience a similar structural transition? Possibly. Could existing systems continue functioning successfully for decades? Absolutely. Nobody knows with certainty. That's why disciplined investors avoid absolute predictions. Instead, they observe evidence. They monitor policy. They follow capital flows. They adapt as new information appears. And speaking of evidence, one statistic deserves special attention. Global demand for physical gold has remained remarkably resilient despite historically elevated prices. Normally, economists expect demand to weaken as prices climb. Yet institutional interest has remained surprisingly firm. That resilience suggests buyers may be motivated by factors extending beyond simple price speculation: strategic diversification, reserve management, geopolitical uncertainty, long-term purchasing power. All of these motivations differ from short-term trading, which brings us back to China's banking restrictions. If policymakers genuinely wanted to discourage gold ownership, they could have imposed much broader limitations. Instead, physical ownership continues. Long-term investment continues. Only certain speculative paper products face restrictions. That distinction continues separating today's headline from the assumptions many casual observers immediately make. It's not necessarily anti-gold. It may actually represent a different philosophy regarding how gold markets should function. Whether that philosophy ultimately proves superior remains to be seen. Markets will decide. Investors will vote with their capital. Institutions will choose whichever systems provide efficiency, transparency, and trust. But regardless of the outcome, one reality becomes increasingly difficult to ignore. The global financial system is becoming more competitive, more regional, more diversified, and perhaps more multipolar than at any point in recent decades. For investors, that's both a challenge and an opportunity, because understanding structural change often matters more than reacting to daily volatility. Daily headlines create noise. Long-term monetary trends create wealth. The investors who consistently outperform rarely chase every market swing. Instead, they study the forces reshaping the investment landscape beneath the headlines. That's exactly why today's discussion extends far beyond gold itself. This is ultimately a conversation about confidence. Confidence in currencies, confidence in financial institutions, confidence in settlement systems, and confidence determines where trillions of dollars eventually flow. But one enormous question still remains unanswered. If China continues strengthening physical gold infrastructure while central banks keep accumulating bullion, how might other major economies respond? Would they simply watch these developments unfold? Or could they introduce an entirely different strategy designed to reinforce confidence in their own monetary system? Because if that possibility becomes reality, it could reshape not only gold, but the future relationship between the US dollar, government debt, and global reserve assets. And that's exactly where our story heads next.